So let's begin with today's session. Type of charts. See, though we discussed type of charts yesterday, but since we have a few new members in our group today, and actually our technical analysis is course is going to start from today onwards. So let's go through these type of charts once again. Now there are basically three kind of charts that are most widely used or most commonly used in technical analysis. Number one is the line chart. Now line charts, as I told you yesterday, are the most basic type of charts because it only shows us the closing price. Now a line chart is formed by connecting the closing price for each period. Now the second type of charts that are used are the bar charts. Now bar charts gives us more information than the line charts in the sense that it also tells us the open, high and the low price along with the close price. Now bar charts are made up of vertical lines that represents the price range for a given period with a horizontal dash on each side that represents the open and the closing price. Now the dash on the left hand side is your closing price and the one on the right hand side. Now the one on the left hand side is the opening price and the one on your left hand side is your closing price. Now the third type of charts which are most commonly and most widely used are the Japanese candlestick charts that we'll be studying in our technical analysis. And today we'll be looking into some important trend reversal candlestick patterns. So now let us see how to read the candlestick first. Now as I told you that like bar charts, candlestick charts also tells us about the open, high, low and the close of any given stock. Now this upper wick is known as the upper shadow and the lower wick is known as the lower shadow, and the shaded part of the candle is the real body, and this high to low is the range of the candle. Now if you are looking at a daily chart, then one candle represents one day, and if you are looking at a weekly chart, then one candle represents 1 week. Now if it's a green color candle, then we can say that today the closing was above the open price, or we can say that today the market was bullish. And if it's a red candle, we can say that today the closing was below the open price or the market was bearish. Now before we move on to the charts or different kind of candlestick patterns, let's see the charts once again. Now this is how your candlestick chart looks like. Now candlestick chart only tells you the closing price. If at any point if you put your cursor, then this will tell you, this will only give you the closing price of the stock. Now this is what your bar chart looks like. See, we have this dash on the left hand side, this is your open price, and the one on the right hand side is your closing price. And one bar represents one day since we are looking at a daily time frame. And since it's a green bar, we can say that today the closing was above the open price. Similarly, if it's a red bar, then we can say that today the closing was below the open price. And this is how your candlestick looks like. This is the lower wick, this is the upper wick, and this shaded part is your body of your candle, right? So now let's look at some trend reversal candlestick patterns. Now hammer candlestick, this is a bullish candlestick pattern. If you see the pattern, this looks exactly like a hammer, and it can be of red color, it can be of green color. The color is of no importance in this candlestick pattern, and this pattern is formed after a long downtrend. So if the stock price is falling, falling and falling, and when we see a hammer candle, we can assume now that the bearish trend is about to end and the bullish trend is about to begin. But we will get the confirmation of trend reversal only if the next day the high of this candle is broken. That will be our entry point in any stock. we can enter into any stock on if the next day the high of the candle is broken, and we can keep our stop loss below the low of this candle. Now in this candle, if you see, the body is very small and wick is very big. The wick can be more than double the size of the body. And as I told you, that color, it can be red, it can be green, it doesn't make an effect. But this candle formation should take place only at the bottom of a chart after a long downtrend. If it takes place, if this candle is formed anywhere in between the chart, then it has no meaning to us, because what we are looking at trend reversal candlestick formations. Now inverted hammer, now this is also a bullish candlestick formation, and this is exactly the opposite of hammer, and this is also formed after a long downtrend. Now whenever we see this inverted hammer being formed, we can assume that now the trend is about to reverse. But in this case also, our entry will be above the high of this candle. When the high is broken, that is the time we can enter in any stock. That will give us the confirmation now that the trend has reversed by keeping our stop loss below the low of this candle. Now this candle can be also be of any color. It can be of green color, it can be of red color. Color is of no importance to us in this candlestick pattern as well. Now right now we are going through the slides of each of these candlestick patterns, but we'll also see these candlestick patterns on charts as well once we are done through with the slides. Then we have a doji. Now there are basically four types of dojis. One is gravestone doji, then we have dragonfly doji, then there is long-legged doji and four price doji. Now in doji, the open and the close price are almost at the same level, and there is no body in doji. The doji has got no body. Now we'll see each of these candlestick pattern in detail. Gravestone doji. Now gravestone doji is a bearish reversal candlestick pattern, and this is formed after a long uptrend. So if the stock price are rising and rising, and when we see a gravestone doji, then we can assume now that the bullish trend is about to reverse. Now from the graves, now these dojis are a best example of a fight between the bulls and the bears. See, the prices opened here, bulls tried to take the prices up, but now bears came in control and they pulled the prices down, and the prices closed at the same level. So now we can assume now that the bulls are taking control over the market. And as soon as the low of this candle is broken, now this can have small wick also, or there can be no wick as well. So when the low of this candle is broken, that is the time we can enter in the stock, and we can put our stop loss right above the high of this gravestone doji. Now since this is a bearish reversal candlestick pattern, so this is should be formed at the top of a chart. Now if this formation also takes place anywhere in between the chart, then that candlestick has no meaning to us. Now similarly we have a dragonfly doji. Now dragonfly doji is again a bullish candlestick pattern. This acts same like a hammer. The only thing is that there is no body in this candlestick pattern. The open and the close are at the same price, at the same level. Now this also gives us a good example of the fight between the bulls and the bears. The bears tried to take the market down, but then at the lower level, the bulls came in control, they pushed the prices up, and the prices closed at the same level where they opened. Now again in this candlestick pattern, the entry for us will be above the high of this candlestick. When the high of this candlestick is broken, that time we can say now that the trend has reversed, and by keeping our stop loss just below the low of this candlestick pattern. Long-legged doji. Now this doji is basically a no trade zone for us, because see, if I tell you that prices opened here, the bears tried to take the market down, bulls pushed it up further, then again the bears came in control and pushed the prices down, and at the same level the prices closed. So there is no decision in the market. The market is in a confused state. So when we see this kind of doji, it's a no trade zone for us. We will not trade when we see this kind of doji on the charts until and unless we get a clear indication of the trend. Now, how will we get a clear indication of the trend? We can mark the high and the low of the candle. Now, whichever side it takes a breakout, whichever side the cap breakout happens, that is the side we will trade. Because what happens that whenever this doji is formed, market remains in a sideways movement for some time. So whenever we see this kind of doji, we are not going to trade. Four price doji. Now this doji is seen very rarely in the market. Open, high, low, close, all are at the same price, and this has got no meaning. It does not affect the trend as well. If you have seen the stocks where there is upper circuit, in stocks where there is continuously upper circuit or down circuit, that is the place where you can see these kind of dojis. But this has got no meaning for us. Hanging man. Now this is again a bearish reversal pattern. Now if you see the picture, this looks exactly like a hammer. In fact, this is a hammer, but the only difference between hammer and hanging man is that hammer is formed at the bottom of a chart after a downtrend, whereas hanging man is formed after an uptrend at the top of a chart. See, whenever there is a formation of hanging man, then its open price should be near the close of previous candle, or it should be above the previous candle. Then it works more better way. Now suppose yesterday it formed a hanging man on chart and today's opening is below the close, then it is a signal of selling for us. Now next day we should see a gap down opening. There should be a gap down opening, or it should break the low of this candle. That is the point where we can enter by keeping a stop loss above the high of this candle. Shooting star. Now shooting star is again another bearish kind of a pattern. It's a bearish reversal pattern, and it looks just like inverted hammer. Now, but the difference is that inverted hammer is formed at the bottom of a chart, and this again is formed at the top of a chart after a long uptrend. If you see the prices, the prices went up and the bears again pulled the prices down, which means that now the bears are taking control over the market and we can see a trend reversal. Now this can be of red color or green color. The color is of no importance to us. Now whenever we see a shooting star, the next day if the low of this shooting star is broken, that is the time we can enter in a trade. And the conditions are the same. We'll put our stop loss above the high of this candle. Now in shooting star, we should also see the volume, as it is of high importance. Volume should be high when there is a formation of shooting star, because shooting star works good if their volumes are high. Now when there is a formation of shooting star, then it should open and gap up to its previous candle. Now there is a long upper shadow in the shooting star. The color, as I said, is of no importance to us in shooting star, and there should be a gap up opening, and volume is very important when we look at a shooting star candlestick pattern. Marubozu. Now Marubozu is a Japanese word which means a dominance. Now this candlestick pattern acts as your trend reversal as well as your continuation pattern. Say if there is an uptrend and if we see a bullish Marubozu, which means that the uptrend is strong and the trend will continue. But if it's an uptrend and we see a bearish Marubozu, then we can say that now the trend is about to reverse. So this candlestick acts both as your trend reversal as well as your trend continuation pattern. Sometimes, most of the times, there is no wick in the Marubozu, but sometimes there may be a small wick in Marubozu as well. piercing line. Now this is again a bullish pattern. Now this pattern means that the bearish time is over and now the bullish moves are going to start. Now piercing line is a formation of two candles. In piercing line, first candle is a long bearish candle. It will be red in color, and the second candle is a long bullish candle, which will be green in color. Now piercing candles forms after long downtrend or at bottom. This signals the end of the bearish market. In piercing line, first candle should be long bearish candle and second candle should open below the low of the first candle. There should be a gap down opening in the second candle. And when second candle closes, it should close at least near the mid of the first candle, or it should close just below the open of the first candle. It should not break the high of the first candle. Now, in this kind of pattern, the volumes are also very important. So, if there's a long downtrend, the market is falling, and when next day when we see a gap down opening and a strong bullish candle is formed along with good volumes, then this gives us a clear indication now that the trend is about to end, and we can see a strong bullish trend. Now, the entry for us in this is when the high of this candle is broken. That is the time when we will enter in the stock, and we can keep our stop loss just below the low of this candle. But in second candle, a gap down opening is required, and good volumes are also required in the piercing line. Now similarly, we have a dark cloud cover. This is just the opposite of the piercing line. Now in piercing line, the first candle is a bullish candle, and the second candle we see a gap up opening, and then the prices comes down and it closes either at the mid of the first candle or just below the open of the first candle. It should not break the low of the first candle. This is also a two candlestick formation that we see. Now in this candlestick formation also the volumes are very important, because if the selling is coming in with good volumes, now that gives us an indication that the bears are taking control of the market, and we can see the trend reversal in the market. Now in this also, when the low of this candle is broken, that is the time when the low of the first candle is broken, that is the time when we enter in the trade, and we can keep our stop loss above the high of this candle. Morning star. Now morning star is a three candlestick formation, and this is also a bullish pattern. Now if you see, the market is falling continuously. Now this is a bearish candle. Now second candle should be a small candle. It can be a red color candle or a green color candle, but there should be a gap down opening, and it should close below the low or below the closing opening price of this or closing price of this candle. And then third candle should again there should also then again there should be a gap up opening, and the entry for us will be when the high of this candle is broken. That is the time we can enter in the stock, and we can keep our stop loss just below the low of this candle. Let's read through the slide. Now morning star is made up of three candles. In morning star, first candle is a bearish candle. It is red in color. Second candle, it is a small candle. It will have shadow on both sides of the body. Color of second candle is not important. It is known as a star candle. Third candle is a bullish candle and it is green in color. Now this can be a candle also. Now this is known as a morning star, and if we see a small doji, then we can call it a morning doji candle then. Doji star candlestick it is known as. Now in this pattern, the first candle should be bearish and second candle should open gap down, and second candle's close should be below the close of the first candle. Third candle should be a bullish candle. This candle should have a gap up open, and when it closes, it should close at least above the middle of the first candle. It should not break the high of the candle. The third candle should not break the high of the first candle. Now in this candlestick formation also the volume plays an important role. Now, evening star is a bearish candlestick formation, and this is just the opposite of the morning star. The market is in uptrend, and this is a bullish candle. The second candle, there will be a gap up opening. Now, this can again be a red color candle or a green color candle. Then there is a bearish candlestick formation, and when it breaks the low of this candle, that is the time we can enter short in the market by keeping our stop loss above the high of this candle. Now in this candlestick formation also the volume plays a very important role. Bearish engulfing pattern. Now bearish engulfing, see, this is a green color candle. Now the if another candle, this is the second candle, is a red candle, it's a bearish candle, and if this engulfs the body of this candle completely, then that is known as a bearish engulfing candle. The body of the first candle should be engulfed completely by the second candle, and the second candle should be a bearish candle. So this is known as a bearish engulfing candle. Whenever we see a bearish engulfing candle, this is a clear indication now that the trend of the market is changing, and we can sell below the low of this candle, and we can keep our stop loss above the high of this candle. The interpretation of this candle is that the bears are selling and the prices might fall down further. Now this is a bullish engulfing candle. The first candle is a bearish candle, and the second candle is a gap down opening, and if this candle engulfs the body of the first candle completely, then we can say that this is a bullish engulfing candle, that the bulls are in control of the market now, and we can enter above the high of this candle, and we can keep our stop loss below the low of this candle. Then we have a bullish harami. Now harami is again a Japanese word which means a pregnant, which means that the second candle is a very small candle. Now bullish and harami means that the first candle will be a bearish candle, and second candle will be formed within the body of the first candle. It should not break either the high or the low of the first candle. Now sometimes this is also, you can also trade this as an inside bar. Now those who are aggressive trader, they enter in the trade when the high of this candle is broken, and those who are a bit conservative, they trade when the high of the first candle is broken. That is the time they enter long in the market, and they keep the stop loss below the low of this candle. Now this is bearish harami pattern. The first candle is a bullish candle, the second candle is a bearish candle, but it is not breaking the high or the low. In fact, the body of the second candle is within the range of the first candle. Now the trading rule for this is also the same. Those who are a bit aggressive, they enter in the trade when the low of this candle is broken, and they can keep their stop loss at this point. But those who are a bit conservative, those who want to play safe, they enter when the low of this candle is broken by keeping their stop loss at the high of this candle. Now let's see each of these candlestick patterns on chart. Now let me show you Reliance first. Now if you see Reliance, see this candle. This is a bearish candle with a long upper wick. In this candle also there is a long wick, which means that there is a price rejection from the higher levels, and this candle is completely engulfing your first candle. So this is a bearish engulfing candle, and when the low of this candle is broken, then you can see the fall in the stock. Similarly, over here, if you see, now see here the doji is formed. Now, since this doji is formed in the middle of a chart, this has got no meaning to us. Now here we have a small Marubozu type of a candle, and see when the high of this candle is broken, you can see a clear uptrend in the stock. See this again, it looks like a hammer. The market was falling, the stock price was falling. This is a hammer kind of a pattern, and when the high of this candle is broken, then the prices started moving upward. See here again we have a hammer pattern. This is red in color, but as I told you that color is of no importance to us. So when it breaks the high, then you can see the upward movement in the stock. Now after an upward movement, now you can say that this is a shooting star kind of a pattern. Now you can enter either at the low of this candle, when the low of this candle is broken, or when the low of the previous candle is broken. And you can see the downfall in the stock from there on. This again is your bearish engulfing pattern. It has engulfed your previous candle completely. There is a price rejection from the top, and then you can see the fall in the prices. Now see this, you can say is your bullish harami kind of a formation. The candle is very small. The first candle is a big bearish candle, and this is a very small bullish harami kind of a pattern. Now those who are aggressive trader, I told you that they can enter above the high of this candle, or you can wait for a breakout above this candle, and you can see in both the cases how the stock has performed after that. Let's look into Nifty. We can see a lot of these patterns. Now see this kind of a pattern, if you see this, you can say is a tweezer top. This is known as a tweezer top kind of a pattern, where the high of both the candles are almost same. So whenever the high is broken, whenever it gives a breakout, you can expect a good movement, as we can see in this case. It gave a breakout the next day, and we can see the upward movement in Nifty. Now see, this is your Dragonfly Doji, and when it broke the high of the Dragonfly Doji, your Nifty went up, and right here we can see your Gravestone Doji. When the low of this Gravestone Doji is broken, we can see a downfall in the market. See this again, after a correction for 2 or 3 days, this is a hammer pattern, and once the hammer pattern is broken, we can see the upward movement in the market. Now this pattern, you can also say this is, you can say as a tweezer top also, and you can say that this is your bullish engulfing pattern. So this again is your bullish engulfing pattern. The first candle is fully engulfed by the second candle, and when the high of the candle is broken, then you can see the upward movement in the market. See here, this is your bearish engulfing pattern. The first candle is a small one, the second candle is a big bearish candle, and when this bearish candle, the low is broken, you can see a downfall in the market. Now see this, you can say is your hanging man kind of a formation. The color doesn't matter in hanging man kind of formation. Now when the low of this hanging man is broken, then you can see the fall in the market. Also simultaneously you have these bearish Marubozu candles. Strong bearish Marubozu candles, and then there is a fall in the market. Now these candlestick patterns, they actually give us a clear indication of as to when the trend is about to reverse so that we can time our trade accordingly. Now see, this is your shooting star, and see when it broke the low of the shooting star, then you can see the fall in the market. This again is your bullish engulfing pattern. The first candle is a small bearish candle, and the second candle is a strong bullish candle. It's almost a kind of Marubozu candle. And when it gave the breakout, you can see the upward movement in the market. Let's look into some other stocks. So this again is your bearish engulfing pattern with long wick, and when it broke the low of the candle, then you can see that the price is of the stock is falling. Now whenever you see this kind of a formation, the long wick formation, it can be either at the top or at the bottom. That means that there is a price rejection going out. Now if you see that in this also, you see that a wick is a bit longer one, and in this also there is a long wick, which means that the bears are not willing to take the prices high, they are pushing the prices down. So that means that something is going to happen in the stock. So whenever you see this price rejection either at the bottom or at the top of a chart, then that is a clear indication that something is about to happen in a stock, and you can see the downfall from there on. Now see, here you can see the fall for these 2 days. Yes, this candlestick patterns works in all time frames. If you can, you can check these in your weekly time frame. If you're doing intraday, then you can check these candlestick patterns in your 15 minutes time frame as well. Each and every candle actually tells you about the sentiment of the buyers and the sellers, that what actually is happening in the market. So if you want to do technical analysis, that then you should be able to understand that what actually is happening in the market, and that you can only make out if you study each and every candle, because each and every candle tells you the story of, if you see, if I'm looking at a day graph, then each and every candle tells me the story as to what is happening in the market. Now see, from here there is a downfall for 2 days. Now here I can see a candle, hammer candle formation. There is a price rejection from this level. So this gives me an idea that if the high of this candle is broken the next day, then that will be my entry point in the stock, and I can keep my stop loss at this point. Because if you see this point, how many times the prices have retraced from this point. See, every time the prices come at this point and the prices have retraced from this point. So now this gives me a clear indication now that after seeing the hammer pattern, that now if the high is broken, then I can take a long position in the stock. Now the high of this candle was around 426. Now if I keep a buffer of say 3 to 4 points, say if I enter at around 430, then you can see the kind of movement the stock has given me. It has made a high of 462, and when I see the price rejection in this candle, when I saw the price rejection in this candle, that was the time that I can exit from my trade. Now see, this again is your bullish engulfing pattern. Now this kind of formation will not be termed as a bullish engulfing pattern because the previous candle is a bullish candle. So this, don't take this as your bullish engulfing. This is your bullish engulfing pattern. And when the high of this is broken, then you can see the upward movement in the stock. Also, if you see, if I keep my cursor at this point, then you can see the high of this candle and this candle are almost the same. So you can say that this is a tweezer top. Tweezer top and tweezer bottom are also very important. Like here, this is your tweezer bottom. The low of both the candles, these two candles are same, but it did not break the low of the candle, so there was no trade for us. Mahindra and Mahindra. See, this is your morning star kind of a candle formation. These three candles, just these three candles. See, there's a downfall in the market. Then second candle, there's a gap up opening. It is a doji kind of a candle, a small body candle. And then in the next candle, there's a gap up opening, and it did not break the high. So when the high of this candle was broken, say above 683, so that was a buy in Mahindra and Mahindra, and it went up till 715. So this is your morning star formation. Now this is not exactly an evening star because this candle has broken the low of this candle, but this is your bearish candle. You can say that this is your bearish Marubozu candle. This also is a bearish Marubozu kind of candle with a small wick. This again is your bearish engulfing candle. You can see the fall in the market. So you need to understand each and every candlestick pattern. You need to identify, you need to fine tune your eyes to locate these candles so that you can decide on your trade based on the formation of a candle. See, this is your bearish engulfing pattern and a strong Marubozu, bearish Marubozu, and you can see the fall in the market from there. In fee. This again is your bearish or bullish Marubozu candle, and you can see an upward movement in the stock. See, this is your dragonfly doji, this candle, and also it is a tweezer top. The high of both the candles are at the same point, at the same level, and when it gives a breakout, you can see an upward movement in the stock. So this way you need to identify the candlestick patterns Anything that you guys are not able to understand or you want me to repeat again, because mm, there are no questions, nothing from your side. So please tell me if there's anything you want me to repeat or that you have not understood. Can you guys hear me? Can you hear my voice? You need to read once again. That is not a problem, Anil. You can go through it. In fact, you'll go through this thing as many times as you want. And what I want you guys to do is, I want you, now that we have a Telegram channel, I want you to find out these candlestick patterns and post these candlestick patterns on Telegram channel. Short detail of all charts, please. Deep, you want me to repeat the candlestick patterns once again, the slides that we have gone through, or just the charts that I'm showing you want me to show those charts? Anil, see, candlestick patterns, they work in your daily time frame also, and these candlestick patterns will work in your 15 minutes time frame if you're doing intraday, and these candlestick patterns will work in your weekly time frame also. So it's not that these candlestick patterns will work only on your daily time frame. Okay, now Deep wants me to repeat the chart patterns from slides once again. Okay, so let's repeat the patterns once again. Okay, now see, this is a this is a hammer formation. This this picture, if you see, this looks like just this just looks like a hammer. Now color is of no importance to us. It can be of green color, it can be of red color. This is known as a hammer candlestick. And this is a bullish trend reversal pattern. And this is formed after a long downtrend at the bottom of a chart. After a long downtrend, whenever we see a hammer candle formation, we can assume now that the trend is about to reverse. But for every candlestick pattern to trade into, we need a confirmation. Now, in this case, our confirmation will be only if the next day the high of this candle is broken. That will be our entry point. That is the time we can enter in the stock, and we can keep our stop loss below the low of this candle. Now in this candle, if you see, the body is very small and the wick is almost double, or sometimes it is more than double the size of the body of the candle, right? And the importance of this candle is only if it is formed at the bottom of the chart. If it is formed anywhere in between the chart, say something somewhere over here, then this candle has got no meaning to us, because we are looking at trend reversal patterns. Now this candle can have a small upper wick, or there can be no wick at all in this candlestick pattern. Now this is an inverted hammer. This is also a bullish candlestick formation, bullish reversal formation, and this is exact the opposite of hammer. And this is also formed at the bottom of a chart after a downtrend. Okay, and the confirmation for this will be when the high of this is broken. That is the time when we enter in the stock, and we can keep our stop loss below this candle. And color is of no importance to us in this candle. It can be of green color, it can be of red color as well. Now next we have different kind of dojis. Basically there are four kind of dojis. One is the gravestone doji, then we have a dragonfly doji, then we have long legged doji, and four price doji, as I said, is of no importance to us. It doesn't affect the trend as well. In four price doji, the open, high, low, close, all are at the same point. Now in doji, in any kind of doji, there is no body at all. Open is almost equal to the close. Open and close are both at the same level. Now your gravestone doji is a bearish candlestick formation. That means it is formed after an uptrend. If after an uptrend we see a bearish this gravestone doji, we can assume now that the trend is about to reverse, because we can say that now the bears are pulling the prices down and the bears are taking control over the market. So if the next day, if the low of this candle is broken, that is the time we can enter in the stock and we can keep our stop loss above the high of this candle. Now this candle also has importance only if it is formed after an uptrend. If it is formed anywhere in between, then this candle has no meaning to us. Now Dragonfly Doji is again a bullish candlestick formation. Just like a hammer, this is formed at the bottom of a chart after a downtrend. And the confirmation for this will be when the high of this candle is broken. That is the time when we enter long in a stock and we can keep the low of we can keep our stop loss below the low of this candle. Now long legged doji, basically it's a no trade zone. We don't trade whenever we see this kind of doji. Now this can be, the wick can be bigger in size, or we can see a smaller doji as well. In both the cases we will trade only when we get a clear trend. Now how we can trade in doji? In this kind of doji or the smaller doji, we can mark the high and the low of both the candles, and whichever side the breakout takes place, that is the place where we trade. But if we see this kind of doji, long legged doji, we will not trade, because once we see this kind of doji, then the market remains in sideways movement for some time. So we trade only when we get a clear trend. Okay, Imtiaz, we will. I'm just coming to the your engulfing patterns also. Don't worry. Now, four price doji, I said this is of no importance to us as it doesn't affect the trend in any way. Now, hanging man, this is a similar kind of pattern like of hammer. The only difference between hammer and hanging man is that hammer is formed at the bottom of a chart and hanging man is formed at the top of a chart after an uptrend. And the next day, if the low of this hanging man is broken, that is the time we can enter short in the market and we can keep our stop loss above this candle. Now shooting star, these are similar to your inverted hammer. The only difference between inverted hammer and shooting star is that inverted hammer are formed at the bottom of your chart, whereas shooting stars are formed at the top of a chart after an uptrend. Now volumes are also important in shooting star. If the shooting star is forming with good volumes, that means the bears are taking control over the market and we can see a trend reversal. Now a selling will be below the low of this candle and we can keep our stop loss above the high of this candle, right? As I said, that longer upper shadow, no importance of color. This can be of green color or red color. Now gap opening is required. That means when the shooting star is formed, then this candle should open gap up. There should be a gap up opening between the previous candle and the shooting star, and volume is very important. Now Marubozu, as I said, it acts in both the ways. This is your trend reversal pattern also and your trend continuation. If it's a bullish trend and we see a bullish Marubozu, that means the trend is very strong and the trend will continue. Whereas if it's a bearish trend and we see a bullish Marubozu, then we can say now that the trend is about to change. Now, most of the times we don't have wick in a bullish Marubozu, but in some cases we may see a small wick in bullish Marubozu or bearish Marubozu as well. Now this is a piercing pattern. Now this is a two candlestick formation. Your first candle is a bearish candle. That means the market is falling, falling, falling. Then after this last candle, the next day we see a gap down opening, but the bulls push the market up, and the closing is either at the midpoint of this candle or below the open of this candle. Below the open of this candle means that this second candle should not break the high of this candle. And if this candle is formed with a good volume, then this gives us a clear confirmation that the trend is about to reverse. The bulls are taking over the market. Now dark cloud cover is just opposite of your piercing line. The market is in uptrend, and this last candle is your bullish candle. Then the next candle that is formed, there is a gap up opening, but the bears push the market down, and the closing is either at the 50% of this candle or just above the opening price of this candle. And volume is also important in dark cloud cover. If the selling is coming with good volume, that means that the bears are now taking control of the market, and we can see a trend reversal. Now in this case, when the low of this candle is broken, that is the time we can enter in the trade, and we can keep a stop loss just above the high of this candle. Now morning star is your three candlestick formation, the one that I showed you in Mahindra and Mahindra just now. The market is falling. Now this last candle is the first candle will be a bearish candle. Then second candle will be a gap down opening, and this can be a green color candle or a red color candle. But the body of the candle should be small. Now this can be a doji as well. And the next candle again there is a gap up opening. But this candle should not break the high of the first candle. So then the morning star formation takes place. Now to trade in morning star, our entry will be when the high of the first candle is broken. That is the time when we enter in the stock, and we can keep our stop loss just below the low of this candle. Now evening star is just opposite of morning star. Morning star is formed at the bottom of a chart, and evening star is formed at the top of a chart. The market is in uptrend. Your first candle is your bullish candle. Now there is a gap up opening. Now this candle can again be of green color or red color, or this can also be a doji, right? Then again on the next day there's a gap down opening. Now this third candle should not break the low of this candle. So our entry point will be when the low of this candle is broken. That is the time when we can short in the market, and we can keep our stop loss just above the high of this candle. Now bearish engulfing. Now bearish engulfing means that the first candle should be a bullish candle, and the second candle there should be a gap up opening, but the second candle should fully engulf your first candle. The body of the first candle should be within the range of the first candle. The second candle should fully engulf your first candle. This is known as your bearish engulfing pattern. And in this case, we will enter when the low of this candle is broken, and we can keep a stop loss just above the high of this candle. Now same with your bullish engulfing. Now this first candle is your bearish candle. Now second candle there is a gap down opening, but this is your bullish candle. The bulls pull the market up, and your bearish candle is fully engulfed by this candle. Now when the high of this candle is broken, that is the time we enter in the trade, and we can keep our stop loss just below this candle. Opening and closing price in case of engulfing. See, in case of engulfing, as I told you, In case of bearish engulfing, there is a gap up opening. Now if it's a now the second candle will be a bearish candle. So naturally your closing price will be at the low of this candle. Now your first candle is fully engulfed by this candle. It is within the range, the body of the first candle is within the range of the second candle. So there's a gap up opening and the prices close at the low. Similarly, in your bullish engulfing pattern, there's a gap down opening. Your first candle is your bearish candle. In second candle, there's a gap down opening and the prices close at the high. See, your second candle, bullish engulfing means that your second candle should be a bullish candle. And bearish engulfing means that your second candle should be a bearish candle. The only difference is that in bullish engulfing, the bullish candle will engulf your first candle completely. And in bearish engulfing, your second candle will engulf your first candle completely. Now in bullish engulfing, our entry will be above the high of this candle and we can keep a stop loss below the low of this candle. Now this is a bullish harami. Now first candle is your bearish candle and second candle is a small candle which is within the body of this candle. Now as I told you, those who are aggressive trader, they trade on the breakout of this candle. They trade on the breakout of the second candle. But those who are a bit conservative and who wants to play safe, they wait for the breakout of this candle. Once the this high of this candle is broken, that is the time they enter in the trade and they keep the stop loss below the low of this candle. Now this is your bearish harami. Bearish harami means that your first candle is your bullish candle and the second candle is a small candle which is within the body of the first candle. Now and for trading this, you need to wait to give it a breakout. Once the low is broken of this candle, that is the time you can enter short in the market and you can keep your stop loss above this candle. Now if you want to show me these candlestick patterns, I can show them to you on the charts as well. So you'll get a clear idea as to what these candlestick patterns they look like. Now whether these candlestick patterns work on all the time frames, then yes, they do work on all the time frame. Now see, as I told you, that this you see is a hammer pattern. Now color is of no importance to us. And see the moment it gave the breakout and you can see the movement in the stock. Can you show Sun Pharma candle? Yes, I'll show you Sun Pharma. Anil, today you traded in Sun Pharma. How was your trade in Sun Pharma today? Now see, this is a strong bearish candle. Now we will consider this as a bearish candle. We cannot consider this as a bearish engulfing because it is not engulfing the body of the previous candle completely. But yes, this is a kind of, you can say, your bullish marubuzu, or you can consider it as your piercing line, you can, or your dark cloud cover. You can say that this is your dark cloud cover. See, these candlestick patterns work in all the time frame. Now this is your daily chart. Now let me convert it to your 5-minute chart. The candlestick patterns work in all the time frame, but for our trading purpose, we see these candlestick formations on our daily chart because our decision to trade always depends on the daily time frame. Now see this candle. This is more like your, bearish engulfing, and then you can see the fall in the market. See, this is more like your dark cloud cover. Not exactly like a dark cloud cover, but then also you can see the fall in the market. See, these candlestick patterns don't work in all the time frames, but for our trading purpose, we are going to identify these candlestick patterns on a daily time frame, because our decision to trade will be based on daily time frame. Now, once you decide to trade in a stock, now if you want to do intraday trade, then you use 5 minutes time frame, 15 minutes time frame, that is a different question. But on a day to day basis, our decision to trade will depend only on our daily time frame, right? Now you can see these on 15 minutes chart as well. See, this is kind of your shooting star kind of a pattern, and once the low is broken, then you can see the fall in the market. Let me show you. Now see Bata, this is your Marubozu candle, your bullish Marubozu candle, and you can see the upward movement in the stock. This is your Dragonfly Doji. Once the high of this is broken, then you can see the stock went up, and then it went sideways. Then you can also check these candlestick patterns on weekly time frames as well. See again, you can see a shooting star kind of a pattern, and then you can see a fall in the market. Now see, this is a Dragonfly Doji, but this is forming at the top, so this has no importance to us. Dragonfly Doji should be formed at the bottom of a chart. Now see, this is your tweezer top, these two candles. And when it gave the breakout, you can see the movement in the stock. This is your bearish engulfing pattern. And then you can see the fall in the stock. Bearish engulfing. Then you can see the fall from here. Now, if you see this candle, though it's not more of a bullish harami, but still it's not a perfect bullish harami. This is your bearish engulfing, and you can see a fall. This is your bullish engulfing pattern. This is again your bullish engulfing pattern, and you can see the rally in the market. Now this is your doji, gravestone doji, and once this doji is broken, then you can see a fall in the market. Tweezer top and tweezer bottom once again. See these two candles. You can say that these are a tweezer top because if you see the high of both the candles are same. The high of both these candles are same. And when the high is broken, then you can see the movement in the stock. Similarly, if the low of both the candles are same, and that is known as a tweezer bottom. Here the low is also same and high is also same, but it gave a breakout on the upward direction. It did not give breakout in the downward direction. See, this is more like a tweezer top. No, it's not a perfect tweezer top. There is some difference. This one you can say is your tweezer top. These two candles. The high of both the candles are same. And this is more like a hammer kind of a formation, and when the high is broken you can see the rally in the stock. See, this is again your bullish engulfing pattern, these two candles, and see the rally in the stock. This again is your bullish engulfing pattern. This is your bearish engulfing pattern. The first candle is very tiny candle, and this is a big bearish candle, and you can see the fall. Now, is there anything that you guys want me to repeat again, or anything that you want me to ask me regarding candlestick patterns? You will get the recording, Anil, not to worry. And as far as the slides are concerned, you can contact the support team. They will let you know. Now, I want you to find out these candlestick patterns and post them on the Telegram channel. I want you to practice as much as possible, not only to find the candlestick pattern, but also to observe how, after the formation of the candlestick pattern, how the stock has moved, what movement the stock has given. So if the bullish engulfing pattern is formed, then how the stock has given the movement. If bearish engulfing pattern is formed, then how it has given movement. Because this is what is going to help you in your further technical analysis. Though candlestick are not the only things that we see, but there are many other factors that we are going to combine. But candlestick patterns helps a lot. Now see if you see this part, this candlestick formation. So you can call this a tweezer top, and you also have a bullish engulfing pattern. And when this range is broken, you can see the movement in the stock from 1874 to 2097. Now, is there anything that you want to ask me, or should we conclude for today? Okay, so no questions. So we'll conclude for today, and we'll see you tomorrow evening again at the same time. But please do your homework, do as much research as possible, go through as many charts as possible, look into the candlestick patterns, try to identify the candlestick patterns and how the stock gives movement after the formation takes place, and post on Telegram channel as well. And this you all are supposed to do, not only one or two. We expect everyone to do the research to identify in the initial stage. You can identify in the initial stage, or you can back test like I'm showing you the candlestick patterns. See, the whole idea is to, so that you should your eyes should get tuned when you look at the candlestick pattern. You should be able to easily recognize that what kind of pattern is taking, for what kind of pattern is formed and how the stock is behaving. Yes, you can take it from the day wise, Anil, from the daily time frame. You can you take the candlestick patterns, because the more number of charts you will look into, the more your eyes will get tuned to it, and you'll be able to recognize the candlestick patterns more easily. So we want you to practice as much as possible. Fine, then we'll conclude for today. See you tomorrow the same time. If you have any queries, you can post your queries on the Telegram channel as well. Okay, bye. Thank you all.